How much do you know about flex mortgages, reverse mortgages, other kind of lending products that are available for seniors, grandparent age folks? Well, I didn't know much of anything, and I had a lot of misconceptions that were carryovers from when I was growing up and hearing a lot of horror stories about these types of loans from back in the 70s and 80s. Stephen Gomes is on with us to talk about how the industry has changed, how these products have changed, and he's going to provide a lot of great information that you can use in making decisions about buying homes, refinancing homes, whatever it is you have going on. I want to make sure you have the best information you can so that you can make great decisions that will help you and help your family. You are really going to enjoy the conversation with Stephen, and you're really going to enjoy in a few weeks hearing Stephen come back on again to talk about his relationship with his grandfather. Hello, and welcome to the Cool Grandpa Podcast. This is your host, Greg Payne, coming at you from Studio 12. This podcast is about being the best possible grandpa you can be, focusing on what it is to be a grandpa and how we can all share that experience together for our grandchildren. I want to remind you that Grandparents Academy is starting up their fall term. Now, this is a great opportunity to get in on some great courses, including intentional grandfathering, that's hosted by myself. Now, go over to grandparentsacademy.com and be sure to check out the course list there. You can also check out my affiliate links and click over to Grandparents Academy through that link. Now, without further ado, let's jump into this conversation with Stephen. And let's learn a little bit more about these interesting loan tools that are available to us. Hi, Stephen. Welcome to the Cool Grandpa Podcast.
Well, thanks, Greg. I'm really happy to be here today.
I'm excited to learn more about these reverse mortgages, the HECMs, all these types of loans that can really, I think, benefit people that are grandparent age, and provide a source of additional income for us.
It's been an interesting road getting to where we're at with it. And I've got to say that it's one of the most fun things that I've done, at least the most fun in a long time. Maybe that means I've got a very boring life, but oh man, I've been involved in the lending world since 2008. When I started working, doing bridge funding and direct money lending for people that were buying bank-owned properties back at that point, working with B of A and Wells Fargo, and where the banks wanted to be paid up front. And so my partners and I would provide the upfront capital while the homes were going through their escrow. And then when they closed, we'd be repaid. And it got me really more involved in it. And over the years, got deeper and deeper into it to where I was running mortgage offices, which were just the traditional forward mortgages, your regular home loans, refinancing, home equity lines of credit, that type of thing. And in doing that, we kept coming across clients that had needs outside of that regular forward mortgage. Out where we're at now, there's a lot of equity in homes. And a lot of our clients were getting near retirement age or in retirement age. And so we started looking more and more into reverse mortgages. And as things evolved, we got so deep into that market that we decided we should specialize, because I kind of, one of my business philosophies is you can do a little bit of everything, but it adds up to a lot of nothing. But if you focus on something, you can do it very, very well. And so that was our goal. And that's why we created Choose Reverse, so that it's focused on that type of loan. And there are other types of loans out there. And if they're better loans for clients, better packaging, we've got other divisions we can move them into to focus on that. But that's how we got into that part of it.
Oh, okay. Well, and that makes sense, especially doing those bridge loans. I know some of just anecdotally, people that were able to get in and buy a foreclosed home, maybe as an additional rental property or something, but didn't have all the cash for that up front. Makes total sense. I think I had some friends that were doing something similar, looking to increase their asset holdings by doing something like that.
Yeah, it turned out to be a wise move for the people around here. Just going through numbers last week, the average home appreciation over the last 10 years has been 9.5%. Yeah, in our state, in California, and very close in other places as well. So it's one of those things where people who are buying in real estate and still do. It's still a very attractive market, even though California has its challenges. We've got a lot of taxes. When it comes to real estate, it's actually one of the better options because we only have 1% tax on the property taxes. And with our Proposition 13 that passed many years ago, it's limited to no more than a 2% annual increase. So if properties are appreciating, basically shooting up, I shouldn't say appreciating rapidly, but if property values continue to shoot up, the property taxes don't keep up with it.
Well, that's a smart move because I do, not living there, we always hear about like the LA market, especially the rise and falls and the roller coaster and everything else where you could end up buying a piece of property. It appreciates very quickly. All of a sudden you're paying a bunch of taxes, you're doing all this stuff, and then it just falls out.
Yeah, definitely there was a transition, and that 9.8% average over the last 10 years includes the fall off that we had when COVID initially hit and when interest rates started to spike up again. It put downward pressure on home prices, and that average includes those elements as well.
Okay.
So, it does have an impact. Home prices out here have been very stable now for the last several months. I think people are adjusting into the new rates. We were really spoiled, I have to say that, by almost free money for a few years during the pandemic. It was a real boom, but most of the people that needed to refinance did so. They got rates in the 2 and 3% range. And so we're kind of back to average. It'll probably in the long run drop another 1% or 2 is what most of the industry experts say. But it's not an unhealthy market. If you're paying somewhere in the 6 to 7% range, it's still not a bad deal. But it does change, and over time we'll see how things evolve. It depends on a lot of things going on with the economy, what's happening with the Fed and what they're doing to try to pull some money out of the economy to prevent inflation. So, in the long run, we take that broad long run picture when we look at the homes. And it's tough maybe for, we've got some, in other divisions, we've got people that are buying their first homes right now. And there's no reason not to. If you can find the right house, we can get a good funding package together. But a lot of people now, our busiest element is choose reverse. We've got so many people coming in and getting reverse mortgages for, a huge range of reasons. Sometimes it's because they want to stay in their home, retire, and maximize their income. And so if they have a current mortgage, a reverse mortgage basically eliminates, or I shouldn't even say that now. It's almost a misnomer to call it a reverse mortgage. We'll call it a flex mortgage, meaning that you can get a mortgage where you can either make your payments or choose not to without any penalty. Traditional mortgage, everybody's pretty familiar with it. You pass your credit. You have a debt to income ratio that you need to have. There's a certain loan to value percentage that you borrow against on the home. And then you make your payments, and your payments consist up front primarily of interest. And then as you continue making payments, more and more equity gets paid down through that term of the loan. A reverse mortgage, you can do exactly the same thing, or you can opt to not make payments ever. And when you don't make a payment, whatever interest was supposed to be paid during that period just gets tacked onto the loan. Okay. So the loan balance will increase over time if you don't make any payments. that's really the difference. And if you choose to make payments, you make payments. It's that simple. But it's not available to everyone because it's structured in a way that, especially the government-backed loans, the HECMs, which is a home equity conversion mortgage, are designed for people 62 and up. And there are certain elements that qualify people for it. So obviously age, you have to be the right age. You have to be a homeowner, and the home that you're borrowing against has to be your primary residence. So you can't do this for rental properties. For instance, if you wanted to buy a rental property, you could rent out part of your primary home, Airbnb and do things like that, but it has to be your primary residence. The other things that are involved would be, taking into consideration when we're talking to people, how long they're going to stay in the home. And if they're not going to be there for more than a couple of years, we're recommending a home equity, line of credit or something as a short-term option instead of a reverse mortgage or full refinance, because it makes more sense financially. But if you're planning on staying in the home and you're of retirement age, in fact, we've got private lines that go as low as 55 years old. And so if you found your forever home, you want to stay there, or stay there at least 5 to 10 more years, this is a nice way to do it and free up cash flow. Or a lot of people do this and they don't take any money out. They just set up a line of credit. And so if they tap into it, they can tap in anytime they need to for whatever reason, and they don't have to make payments on it.
Okay.
Yeah. And, and so it's one of those things where a lot of other clients, we've got some clients that use it as an income source. So in essence, they tap in, they borrow against the equity in their home, and they get monthly distributions, so they might be getting $2,000, $3,000 a month or more, depending on how much equity they want to tap into. And it just becomes supplemental income without any payments going out. So it makes it much easier to retire comfortably, enjoy your life, travel, not worry about bills, spoil the grandkids, whatever you want to do with it. And then there's no real limitation to these two, because you can do a combination of things. You could pull a little bit of cash and do some remodeling to your home and just leave the rest available as a line of credit if you ever need to, or combination of pull out cash, take monthly distributions, and still have a line of credit left over too. So all these things are just very, very flexible in it. And that's why we need to talk to our clients and find out exactly what it is they want to do. And then we help tailor a package and make sure there's a good fit.
Okay, that makes sense. One of the questions that I have for you is, how are the products today different from when these first started, maybe 20, 30 years ago? Because in my mind, I still have these images of an older couple that signs a reverse mortgage. The husband, who probably had the note in his name, dies. The next thing you know, mom has 3 months to get out of the house. And, these sorts of things, which maybe still resonate or residual from an earlier time.
That is a great question. It's kind of like, I'll equate it to originally when reverse mortgages started, it was like the Wild West. There were no real regulations. There were no groups lobbying for controls or things like that. And that exact scenario could be dealt with easily, but things like that could happen. People were borrowing money, and they were borrowing at such a large percentage of the value of their home that if the home didn't increase in value, there was almost no equity left in the house. That type of loan completely changed decades ago. The federal government stepped in and set regulations. AARP stepped in and made they really lobbied hard and made some great changes. And so the loan products that we deal with now are a completely different animal. If a spouse passes away, we're doing this right now, in fact, where their boyfriend, girlfriend, they're in their late 70s and early 80s, and he wasn't on title. And so if she passed away, he would have to move out within a year. We very simply work with them to get their trust updated, put him on title, added him to the loan. Makes no difference on the loan payments or anything like that. And now if one spouse, or I should say spouse, one partner or the other partner passes away, nothing changes. The remaining partner stays in the house as long as they want, never having to make a payment. But that is something, that was wrong with it way back when. Okay. The other part is it's a non-recourse loan. It's the safest loan that anyone can get on their home for the sheer fact that you can't lose your home as long as you're paying your property taxes so that your home's not going to be seized. And that's very, very important. Maintain the home so that it's not red tagged, so that you're not forced to move out, and pay your insurance. Those are the only obligations you have on your home. And say the economy was to crumble and you borrowed 50% of the equity in your home and the home drops by 60% or 70%. The world turns upside down. It's crazy. You never have to move. You never have to pay back that differential. Your heirs never have to pay back that differential. It's absorbed by the lender, and the lenders have private insurance to cover any weirdness that happens. And when it's a HECM loan, which is a government-backed loan, it's a government-based insurance package that covers that on the lending side of it. So if your house is worth $1 million today and you borrow $500,000 and in 10 years it's worth $300,000, you can continue living there forever, not having to make a payment, and your heirs won't have to pay anything. So that's what the non-recourse part does. And AARP they were instrumental in making that happen as well. So, that, and then a bunch of other regulations, it's almost impossible to get upside down in a property because we don't loan the majority of the equity in a house. So if you have $1 million of equity, to have no mortgage, you're probably only going to be able to borrow about 43% on average. And it depends on your age and geographic location and things like that. But, it could go up. The older you get, the more you can borrow against it. But there are definite controls there. There's that scenario people talk about where, the reverse mortgage grows so large that it's worth more than the value of the house. These regulations and controls basically, they make it almost impossible for that to happen because the interest rate on the loan is probably less than the appreciation rate on the house. And borrowers are only borrowing against part of the equity. So in round numbers, if your interest rate was 10% and your home appreciation was 10% and you borrow half the money in your home, you're still gaining appreciation. Basically 5% of the value of the home appreciates every year. So you're still adding value to the home. That was another thing that had to be fixed, and that was done years ago. So the scariness is out of it, but there's still that stigma because there were some bad examples back in the late 70s all the way up into the mid 80s, before regulations really came into place. But that was before my time in that part of the business, but I still hear those horror stories.
Right. Well, it's almost like hearing about Pintos blowing up, right? Mm-hmm. Like, yes, there were a few of these things that happened and Ford had to take, measures. But when you ask people about Pintos, it's like, oh, that's a death trap. I'm never getting into it. You know what I mean? But once it gets into that social consciousness, it's like, it's there.
I'll admit this. In high school, I dated a girl who had a Pinto, and I lived. So it was okay. But seriously, there are a few stories out there, and then they get told over and over again, and maybe they get a little elaborated on, it grows a bit. But it's very, very hard to lose your house if you have a reverse mortgage. It's much harder than it is if you had a regular forward mortgage. But that's also because of all the protections, because we're talking about what I believe it should be a protected class. Now that I'm joining that class and about to qualify one more year and I'm 62, to protect the senior citizens in the country so they've got happy retirement and don't have to worry about putting a roof over their head. But we do a lot of different types of things too. We've got, there are a couple clients that have done this now where we did a loan for them a few years ago, reverse mortgage, and it's just like any other kind of loan. You can always refinance it anytime you want. And so, what also happens is over time, homes keep appreciating and they can access more equity. This couple nearby decided they wanted to help their kids out. Their kids did not want to move into their home. They wanted to live in another state. They wanted to move to Texas. So we refinanced their reverse mortgage, and they pulled out enough equity to buy a home free and clear for their kids in Texas for them to move. So the kids could do that, get on with their life, have a home, and the parents had no payments for it, anything like that, because they just tapped into their equity and don't have to make mortgage payments because they did it as a reverse. Worked out really well. Everybody was thrilled.
Sure. No, that's an amazing story, and what a way to kind of bless your kids and give them a leg up, in life. You take off that, whatever that mortgage payment is, all of a sudden that's going back into their daily expenses or savings or whatever that is.
Right.
Now,
and it didn't change their lifestyle in any way, shape, or form. They're under, they still have the same cash flow, all of that. Dealing with a lot of clients, they use this just as a safety net. They'll go ahead and set up a reverse mortgage as a line of credit. And there's no cost, no monthly deduction. It's not accruing interest against their house. The only time you accrue interest is if you draw against the line, and it's only for what you draw. So if you have a $500,000 line of credit and you end up pulling a total of $50,000 out of it, you're only owing the interest on the $50,000 and the $50,000 itself. That's it. And then other people want to do that and combine it with, say, some upfront equity. The client we just closed on last week. Wonderful woman. She's 80 years old, has almost no cash flow, but her house was starting to fall into disrepair. She needed some contractors coming in, doing some work to fix it up, has a ton of equity. And so this was a perfect vehicle for her to take care of getting money to do the contracting work and get the house painted and repairs done and all of that stuff without any, imposition on her and her cash flow. And worked out great. And she's got the rest available as a line of credit. So if something comes up, or say she needs in-home care down the road or things like that, she can always tap into it when she needs to.
Well, and that's a great point. And it leads me to one of my questions, which is, if somebody was to do this and they wanted to put an addition onto the back of the house, or they needed to do some major structural work, do they need to go through the lender first and get permissions and get things signed? Or is it a case of you're still the owner, you're still the resident, you just do it?
You just do it. It's just like any other kind of loan. You are on title, you own the house. You're just taking a loan out, just like you would if you were financing in a forward direction mortgage. And in fact, remember, these are flex mortgages. You can pay them or not pay them, which is very different than they used to be. And so, yeah, it's your house. And a very common thing is for people to use some of the funds from reverse mortgage to fix up their home, make it the way they want for retirement, that kind of stuff. Maybe you want to build on that game room and the pool for the grandkids and things like that. You do it, or you add an ADU on the back of the property, and so family can come out and visit and have a little place to stay. So yeah, I see that a lot, definitely.
Okay, cool. Well, and I was also thinking too, in terms of the folks that need to then maybe start to put a ramp up the front steps and do some of those things in order, like you were talking about, to stay in their home longer, which is part of what this product is about. It's, not needing to find the ground room or ground floor apartment and moving out of the house to that because you can't do steps anymore.
Absolutely. That, and also bathroom and kitchen remodels to make them more accessible. Definitely big things, wider doorways, remodeling bathrooms so that they're easier to move around in if you are using a walker or wheelchair. Remember having to do that for my dad, did full remodels and stuff to make everything easy, including a roll-in shower for him, that kind of stuff. Very popular ways to use it. And it's a great way for people to be able to stay in their home. Another thing that happens is when it's a couple, sometimes one needs to go into managed care and go, and leave the property and have full-time assisted care going on. That is a great opportunity to use funds from reverse mortgage because that's expensive, and insurance often covers very little of those costs, and it can get very expensive very quickly. And so one spouse will be remaining in the home and use the funds to help with the outer care. The other thing that's interesting is, in-home care is growing, at least in our area, more and more and more. And so it's another way for people to not even have to leave their house and get the care they need and tap into that equity. One of the things that's also interesting about this is it's tax-free. So in other words, if you're pulling out $100,000 or $500,000 or $10,000, it's basically considered a loan. And so it's not going to affect Medicare or any of those benefits. And it's not a taxable event, so you're not having to pay income tax on it as well.
Oh, that's cool. Can people that are still working take advantage of this, or what are the work requirements around getting one of these loans?
That's a great question. People think you have to be retired. No, you can be working full time. You can work 3 jobs if you want to and still do this. It's not really dependent on how many jobs you work. In fact, the income requirement goes the other way, where you don't have to have a lot of income. All you have to prove is you've got enough income coming in to pay your insurance and your property taxes, that type of thing, the basics there. So you don't have to go through as deep a credit background check and have good credit and all that. In fact, you don't have to have good credit, and it's not going to be a big impact on your rates. But yeah, a lot of our clients do work, and they use this as a safety net or ways to do a remodel and keep cash flow in. After the pandemic loosened up and things started to get a little bit more back to normal, a lot of people didn't go back to work, or they're working part-time, where they're working something at a reduced pay. And if they're of an age to qualify for reverse mortgage, it's a huge relief to not have to make a mortgage payment. So there may simply be just refinancing the balance of their mortgage. That was what we call kind of a flex mortgage, so they don't have to make payments. Or if their things get better, they can just make payments like they would normally if they want to pay down the house and say they want to maximize the amount of equity going to their heirs. They can do that. But yeah, no penalty if you want to work at the same time. It's just, again, it's your house. You're just taking a loan out on your house.
Okay.
That's all it is. Yeah.
And it sounds like too that there aren't any restrictions about the money that you're getting for the loan. Is that right, or are there any kind of strings?
No, that's absolutely true. I mean, we do counsel our customers, our clients on this, and there is also we require that they go through an independent third-party counseling session. It's usually done by phone now. Before it was in person. After COVID, now it's just a phone interview, where everything's explained to them by a third party. They understand exactly what they're getting into, exactly what the loan is, how it works, how much equity is in there, and all of that type of stuff. Those are essential, because when somebody says they want to do this and they're going to buy 1 million lottery tickets, we will look at them, we'll sit them down and go, this is not the way to use a reverse mortgage.
Right.
It's like, that's not what that is. That's not what it's intended for. The truth is, they can use the money for whatever they want, but part of what we do, and we've got people with their Series 7 that are fully certified to provide investment advice, is, make sure that this is the right thing for them. There are other times, we talked a little bit about it earlier. Somebody might not be in the house for that long. Like me, I'm in a house right now. I've got a 5-bedroom house with an office and all this stuff, and I'm an empty nester now. So there's 2 of us living in the house, so we're empty nesters. I'm probably not in my forever home. I think that's a safe statement. Also, it's a 2-story and split level. As I play a lot of sports, so my knees are not happy here.
Right.
So I'm not a good candidate to get a reverse mortgage when I turn 62. But I may do a reverse purchase. And I've got cash flow and things like that, but it's such a neat option. When I sell this house, what do I want to do with the equity? Right? Just that's a question a lot of people are going through. I'll take part of it and buy another house. That's easy enough. How much do I want to spend on the house? And how much do I want to leave as cash for investments to grow and use as my retirement? And so a few years back, they came up with a reverse mortgage for purchasing. And this is something I was talking to a real estate agent. I met with him last week. He didn't even know this existed. Wow. And it's relatively new, but it's been out and been going on for about 10 years now. And it works on the exact same terms as the established refinancing version of the reverse mortgage. But say you want to buy a property and you've sold yours and you want to buy a new property for retirement. And let's use round numbers again. Depends where you live, if this is high or low, but say it's $1 million for the house you want to buy. You can go in there with, say, depending on your age, it could be anywhere from 500,000 to 600,000, just roundabout. Put that money down and never have to make a payment on the balance. You got $400,000 or $500,000 balance of equity you don't have to pay on. So that allows people to buy a retirement home, put away a bunch of money set aside for their retirement, and get the house they really want instead of having to buy down to a lower house. A very nice opportunity for a lot of people. And when they do that, again, it's about quality of life. I mean, that's why I like reverse mortgages. There's 2 types of loans I love. First-time home buyers getting into their house and just so excited, and just getting in there and doing that. And when we've got division, we still do that. I mean, it's a friend's son is doing that right now, excited for him. And then the other one that I really love is when you change someone's quality of life for the better. And so if you're looking at retirees that are just struggling, they might even be making a mortgage payment right now, and the money doesn't go very far. And with inflation and everything, it's changed people's perspectives on retirement. A bigger percentage of people now think they'll never be able to retire. Another big number think they're going to have to continue working many, many more years before they retire. And there are a lot of people that are now retired on basically a fixed income that are really stressing because it's so expensive, whether it's buying a new car or gasoline or, the utilities for your house or the food costs or everything else or travel to go visit family is all gone up. And so when we do things for people that can change their life like this to where they've got the flexibility now, they've got the freedom, they've got the peace of mind, a weight's been lifted. It's like, I don't have to worry about making those payments every month. That's a great feeling. Really good.
Yeah, I can just imagine the stress being lifted off of somebody. And again, just sample numbers, an extra, let's say the mortgage is $1,700 a month, just having that back in their pocket that they don't have to stress about when you take the car in to get some service and they go, oh, by the way, you need another $700 worth of just maintenance stuff, right? Preventative maintenance. And all of a sudden it's like, okay, it's a pain in the butt, but I can do this versus the stressing out part.
Absolutely. And we also very often counsel our clients to not take all the cash out at once. If you don't need it, don't take it all out. Take it out as you need it. So if you have things that you need to get done, car repairs, home repairs, things like that, take out whatever you need to do that. And then leave the rest as a line. So if you have, I'll just pull a number out there. I just got my car back from the dealership after they go through it. We'll call preventative maintenance. I need 2 new catalytic converters. The cost of them is over $7,000.
Wow.
I was floored. Wow. Do I want to keep this car at this point?
Right.
And so if those things, they come up in life, this is where you can absorb it without any hiccup, any change in lifestyle, any stress. And when we talk about this, it's like, oh my gosh, I start thinking, well, what happens to, my kids? What are they inheriting? Here's the neat part. Because of all the controls in place, limitations, controls on fees, interest rates, non-recourse, the reverse mortgages today are really designed to preserve equity in the house. So we're talking about people that aren't a good contender for reverse mortgages. First off, if you're not of the right age, you can't borrow. Secondly, if you're only going to be there for a year or two, it's not really worth that. There are other kinds of short-term loans to get. The third thing, which is really, if you think about this in the big term, sometimes people need to access a lot of money, as much as they can, out of a home. A reverse mortgage has limitations. You can't do that. You can't borrow 80% of the value on your home on a reverse mortgage. It's designed, and it's been built in over the decades now that they've evolved it, so that equity is preserved in the house. So your heirs will have something to inherit, if that's the case. Or also, there's just also the fact that it's going to prevent you ever gobbling up all the equity in your home. There'll always be some equity there. And when people take a line of credit out on their home, say there's $400,000 they could take out when they do a reverse mortgage today, and in 3 or 4 years that home's appreciated, that line of credit actually grows proportionately with the value of the home. They don't have to do a thing. So in a few years, that $400,000 available could be $500,000 available. And meanwhile, their $600,000 of equity in the home has grown to $750,000 of equity at the same time. So it takes all those factors into play. They have very, very sophisticated calculations that they use. And, it also depends on the age of the borrower, on how much they can access in the home. The older you are, they figure, okay, the less time you've got to live, the more we can let you borrow, that type of thing. So you can get a higher percentage if you're 95 years old than you can if you're 65.
We hit on this a little bit, but who isn't right for one of these flex mortgages?
First off, I hate turning people away on this, but there are some people that have borrowed so much against the equity in their home that they don't have enough to make it worthwhile. Going through the loan process. And so if they, just as an example, say they have a home that's worth $500,000 and they owe $350,000 on the home and on the primary, and they've got a $50,000 second mortgage, there's not much equity left in the house. And so this isn't the right vehicle for them. In fact, it's probably going to be something where we would suggest they go and try to restructure, get rid of the expensive second, maybe do a traditional refinance so they can have a larger amount of cash out and get the best rate possible and buy down that rate so that they pay lower than today's market rates for that loan. Definitely. There are other borrowers. One guy we just talked to, he is 75. He's got a girlfriend that is, I think she's 50. And he doesn't want to get in a situation where she can't be on the loan because of reverse mortgage, because she's not old enough to qualify. And if she was just the bare age, that could work. But if he does a reverse mortgage now, she'd have 1 year to either refinance or buy out the home or sell the home, that type of thing. And it could be his spouse as well. In fact, if they were married, you have to have that age requirement met of 55 or over for a private loan, 62 or over if it's a government-backed loan. And so, again, that scenario just wasn't going to work. He wanted to make sure she was covered and protected without having to make payments. It doesn't work that way. She still has to qualify herself by age. So those are some of the things there. There are other times, when people aren't going to be in the home that long, like they're thinking they're going to be there maybe 2 more years, we will counsel against getting the loan. If they need money for short term, it's better in the short term to just take, let's say a home equity line of credit or something like that. If there's something they need to do, say they want to fix up their home to sell it. A reverse mortgage is not the right vehicle for that. You want to take just a short-term bridge loan, take that out, and then make those repairs and then sell the property.
Well, I appreciate the information. And Steve, is there anything about the flex mortgages, reverse mortgages, the business you do at Choose Reverse that I haven't asked you that you would like to bring up?
We've covered a lot of stuff. We could go on all day, but I know there's limitations to how long people are willing to listen to me ramble on about this stuff. I would just say this: if you have an interest and this has piqued a little bit of, an interest in it, you've got some curiosity, just go take a look at our website. It's got a wealth of information. It's all free. We've got sections that cover all the frequently asked questions about our reverse mortgage. We have a free reverse mortgage calculator right on the landing page. You don't have to even give us any of your personal information to use it. It's just there to use and give you an idea. And then if you do want more information, you can click the next button on there. You can provide some contact info, just basically your name and your email, and we can have somebody reach out to you and get a little bit more information. Usually it's just an online form link we send. You put a little bit more information, then we can give you a free option report and let you know what it looks like. And we don't say, here is the loan. We basically gather enough information to get an idea of what you're looking for and what would fit best. And we usually do an option report that provides 3 different scenarios side by side, so you can see exactly what the options are, what the estimated equity is going to be in your home in 10 years, what the total payments are, how much you can access, if you want monthly distributions, all of that stuff. And a nice side-by-side report. We do not sell or share anyone's information. It's all private. We're not one of those things where if you give us contact information, you start getting bombarded with sales calls and offers or things like that. That's not how it works. We control the entire environment. So that will never happen. Anyway, so those are the things to do, but it's just, visiting choosereverse.com. It's a great start to take a look at it. And again, there's a calculator there right on the landing page that you can play with, give you a good idea of what's available.
Oh, yeah. And I can attest to how nice of a website you have, because in some of those FAQs that you've got going on, you provide, not only the definition of, an appraisal, but then there's also a little short scenario that makes it extremely clear. So there's a lot of great information, including you've got a blog on there as well, where you break down and you give a little bit more detail with some great links within the blog if people want to dive further down into some of the data. So I appreciate it, Stephen. And
thanks. Yeah. We keep that up too. We always put new content and articles in there. And then we also have what we call our living section, where we have content articles about finance, lifestyle, and housing that are for our target market, for people 55 and over, important things that are happening in the world. And so we always maintain that and keep that content up there too. So it's just a fun resource. I personally like the recipes in the lifestyle section. There's some stuff there that healthy desserts. So if I can say that, I know that's an oxymoron, right? Healthy in the same sentence. But there are some things out there that are very tasty and not bad for you. So.
Well, very cool. And Stephen, I've had you on for a little while, and I really have appreciated this conversation. It's cleared up a lot of information for me. Like I said, I had all these misconceptions and I had all this data that I had heard about, and this conversation's gone a long ways to clearing that up. So thank you.
Well, I appreciate the time today. It was really fun talking with you, and really looking forward to hearing it back and maybe doing this again sometime. There's a lot more we could talk about.
Absolutely. And folks, I'll have links to everything we talked about in the show notes as well. If you're out walking the dog or taking a drive or whatever, and you're listening to this, we'll have everything so that you can get connected to Stephen and Choose Reverse, easily available. So thanks again, Stephen. I appreciate it.
Thanks, Greg.
I really appreciated Stephen coming on to the podcast to talk to us and help educate me specifically about reverse mortgages, flex mortgages, all the different products that are out there that we could take advantage of when you're, of course, of age and that the circumstances are right for you. I enjoy the fact that Stephen and his organization really focus in on understanding why you're getting a loan, why you're looking to do what you're going to do, and then being able to counsel you on how that's going to affect all your long-term planning. Because if you get into a bad product, it's no good for you, it's no good for Stephen, it's no good for anybody. So I really did appreciate him breaking things down, providing great scenarios and great examples that we can use to easily digest this information. So if it's right, what I'd love for you to do is make sure that you check out the links in the show notes and head over to OPTIO Financing, learn a little bit more about these products, and maybe get in touch with Stephen and his team to help you navigate through all your different options. So I hope you found this interesting, and I hope that you share this with some friends and family that could really use this information if they've got decisions coming up about buying or selling homes. So until next time, remember to stay cool. Thank you for listening to the Cool Grandpa Podcast. If you've enjoyed this episode, please do me a favor and share it with a friend. That's the best way you can help us to expand our community, as well as get the news out about how valuable grandpas are in the lives of those kids. If you'd like to leave me a comment or shoot me a potential topic for this podcast, please go to www.cool-grandpa.us. Look for the comments tab, fill it out, hit submit. It's as easy as that. Until next time, remember to stay cool.